Hello and welcome back to Principles of Accounting 1. I'm still your host, your Dr. B. Uh, so let's take a moment to talk about liabilities. And more specifically, we're going to focus on long-term liabilities. Who can tell me, what is a liability? What's a liability? You all know the answer to this question. What is a liability? Who can tell me?
Is that something that occurs something about cost in the future?
No, not quite. Well, no. No, that's the opposite.
Where you can experience loss.
Like a car is a liability.
It's a long-term liability, yes. Yeah, an example of a long-term liability is a car loan. Yeah. What is a liability? I mean, what does the word mean?
Me, it means debt.
Correct. That is correct. It is debt. You nailed it, Asia. Yeah, debt. Debt is anything the company owes to someone else. It's a liability. Anything the company owes to someone else is a liability. Yep. Talked about that, I don't know, first week class, second week class, right? Yeah, liabilities. Anything the company owes to someone else is a liability. Now, we already got one example of a long-term liability, and that was a car loan. Anyone else? What is another example of a long-term liability? Car loan. What else?
Mortgage,
Mortgage. Yes, absolutely.
insurance.
Sure, it depends. It depends on the policy.
Depending on the insurance, depending on some factors.
Yeah. What does the word long-term mean? What's the
More
time
than
frame?
a year.
More than a year. Yeah, more than a year. Long term, more than 1 year, more than 12 months. Absolutely. Very well done. Yeah, so we're going to talk about these things, yeah? But we're going to look at it from an accounting and finance perspective. So you know that a long-term liability is something that the company owes greater than 1 year. Okay, you know that. That's what a long-term liability is. But we want to look at that from a perspective of finance and accounting. And companies, corporations specifically, use a couple of different ways to raise capital, right? We know that one of them is through stocks. But another way that a company will try to raise capital is through bonds. So corporations will look at measures to raise capital over time. Yeah. One of these is called a bond. A bond is very similar to a long-term bank loan. A bond is very similar to a long-term bank loan. It's not the same thing. Those are different. But a bond has similar characteristics. A bond is like a bank loan, but the debt is carried by the corporation or investor. Yep. So here's how debt using a bond works. A bond is where the corporation will pay interest on the bond note to the investors over time. Okay? They'll make what's called bond interest payments over time. That's what a bond is. It's like a bank loan that an investor gave to the company, the corporation. And in exchange for that bank loan that the investor gave to the corporation will pay investors what's called bond interest payments. Okay, and that starts at the bond issuance date, and it goes all the way until the bond maturity date. To calculate the interest payment, the formula is the bond at par value, the contract interest rate of the bond, times time, the amount of time for the life of the bond. Yep. A couple of advantages of using bonds for debt financing for the company. Bonds do not affect ownership. A bond is simply like a bank loan that's held by an investor instead of a bank. The interest on the bond is tax deductible. That's cute, right? The company can save some tax money. Bonds can increase the return on equity. That makes the company more attractive to new investors. Disadvantages of bonds instead of issuing stock is that bonds require payment of both periodic interest and par value at maturity. So the way to think about it is that, let's say you decide to give the company a bond for 2 years at an interest rate of 12%. And let's say it's for $200,000. So what will happen is that every month or every quarter or biannually, whatever the agreement is, the company will pay you the interest rate only. At the end of the 2 years, when the bond matures at its maturity date, that's when you'll receive the par value of the bond, the $200,000. So that's an advantage and a disadvantage. Bonds can decrease the return on equity. Yeah, that's certainly possible. Bonds are like loans. It's a form of a security that can be purchased or sold on the security market exchanges. Some of you might have a student loan or a mortgage or even a car loan. And once in a while, you'll get a letter in the mail saying your loan has been sold to another bank. Your loan has been sold to another bank. This is common. Car loans, mortgages, student loans, any kind of loan. A loan is a form of a security, and that security is bought and sold in securities markets. Happens all the time. And me recently, actually, my mortgage went from one bank to another because one bank decided to sell my loan to another bank. That's very common. They have the market value of which that is expressed as a percentage on their par value. In other words, it has the interest rate expressed. There's usually a closing price involved when the two banks exchange the note. Here we have an example. One company held a bond for IBM. And IBM, the expressed interest rate changed when the bond was bought and sold. This kind of shows the example of this. It's called bond trading. We're not going to dive too deep into that because, again, this is an accounting class, not a finance class. The reason why it's important to us in accounting is that we need to record those entries. And so we record bond issuance and interest rate expenses. When a bond is issued, we debit cash because the company's receiving cash for the bond. We credit what's called bonds payable. Remember, the bond is held by an individual or another company. It's basically a loan. We issue the bond. The company gets the cash from issuing the bond. So debit cash, and we credit what's called bonds payable. It's just like notes payable, but it's a bond. That's the only difference. Yeah. So here's the bond. Par value, also known as face value, $100,000. Interest rate, 8%. Interest dates, 6/30 and 12/31. What this means is the company will pay the bondholder interest twice each year. Yep. It has maturity date 2 years. Yep. 12/31/21 in this example. So we got a 2-year bond, interest rate of 8%. The interest is payable twice per year. So we need to record the interest payments. So June 30th rolls around. The first interest payments due. We debit bond interest expense $4,000, credit cash $4,000. How $4,000, you might be asking. And you probably remember this formula from, I think it was last week or the week before. Interest times the face value times time. Yeah? Or face value times interest times time. Whatever. Same, works out the same way. So face value, 100,000. Times interest, 8%. Times time, half a year. Why half a year? Because the interest is payable twice per year. Happens every 6 months. That's why half a year. So 100,000 times 8% times half a year equals $4,000. I do that twice. I do it once on June 30th, and then I do it again at the end of that year. So 12/31/2020, I'll do it again. And then I'll do it twice in 2021. June 30, 2021, and December 31, 2021. But all at the end of the bond, when the bond reaches its maturity date, meaning when the face value is due, we debit bonds payable, 100,000, and we credit cash, 100,000. So again, the way I want you to think about bonds is that they're basically private loans that other people or entities hold other than banks. Sometimes a company might issue a bond on the open market through what we call a bond exchange. And that bond exchange is where buyers of bonds will buy the bond at either a premium, at par, or at a discounted rate. The company sells the bond on the bond exchange. They'll sell it at either a premium, at par, or at a discounted rate. Here's another example. In this example, we're going to use what's called a discounted bond. Bond has a face value, par value, 100,000. We're going to issue that bond at 96.4% of the par value. Meaning, instead of issuing the bond at 100,000, we're going to issue it at $96,400. The reason for that is because we are discounting the bond. The bond itself has a stated interest rate which may be different than the market interest rate. The market interest rate set by usually like the central bank or the market itself might set the interest rate. So the stated rate in this case is lower than the market rate, which means the bond will sell at a discount. So when the stated rate is lower than the market rate, it will sell at a discount. That's what that means. Bond has two interest date, well, technically four interest dates because it's 2 years, 6/30 and 12/31 of each year. The bond is issued on December 31, 2019, and it matures, meaning due in full, on December 31, 2021. Question?
Yes, Professor. You said that when the stated rate is lower than the market rate, it's discounted, right? Or is that the other way?
That's
around?
right.
Okay.
Yeah, that's correct. Yep.
Okay, thank you.
You're very welcome. Absolutely. Yeah, anytime that the stated interest rate is lower than the market rate, it's called a discount. If the stated rate was above market rate, then it would be at a premium. So above market rate, premium. Below market rate, discount. Great question. So remember, we're issuing this bond at a discount. So the par value is $100,000. But because the bond is being issued at a discount at 96.4% of the face value, the par value, the company will receive $96,400 in cash. Exchange for the bond payable of $100,000. The difference is the discount amount. The discount on the bond payable is $3,600. How we got that amount? We took the par value minus what we actually received in the cash, $96,400. $100,000 times 96.4% is $96,400. So that's how we got the $3,600, yes? The discount on bonds payable account is called a contra liability account. Contra liability account. Remember, a bonds payable is a liability, right? It's a long-term liability, especially if it's greater than 1 year. Now, the difference here, of course, shows the discount on the bond payable. That means that the discount on bonds payable is a contra liability account. It contraflows with the bond payable account. Yes. In other words, it's kind of like, meaning it's a debit account that's actually a liability, right? It's another way of thinking about it. The interest. So the interest, of course, it's 8% at $100,000 face value, right? The carrying value is $96,400. That's in other words, the carrying value is the net value. The net value comes from the face value minus the discount amount. 100,000 minus the 3,600 is 96,400 carrying value. When we pay interest, we are paying it with the 8% and its maturity value, 100,000. So over time, I'm going to make 4 interest payments. Remember, the loan is for 2 years, or the bond is for 2 years, which means I'm going to make 4 interest payments total, 2 per year, one on 6/30 and the other one on 12/31 for both years. So that's 4 interest payments I'm going to make over time. Each interest payment is $4,000. How we got there? $100,000 face value times 8% interest times time, half of 1 year. So I'm going to make 4 interest payments of $4,000 each over the course of the 2 years. So that's a total of $16,000 in interest payments I'll make. Plus the discounted amount, $3,600, gives me the total bond interest expense, $19,600. Find the total bond interest expense per interest period, meaning every 6 months. I take the $19,600, which is the total bond interest expense, divided by the number of interest periods, 4 interest payments. So $19,600 divided by 4 is $4,900 interest expense per interest period, meaning every 6 months. So I debit bond interest expense, I credit discount on bonds payable, and I credit cash. Okay. Amortization gets a little confusing. Again, this is another finance concept. Amortization. Amortization is kind of like a schedule that shows us the amounts that are paid over the carrying value over time. Call it amortization. An amortization schedule shows us the amount that needs to be paid over time. Yep. This is common with mortgages, car loans. These things amortize over time, yes? A lot of long-term liabilities are amortized. The amortization schedule shows us the amount of interest that's paid over time. Yep. And so oftentimes we use what's called the straight line method to amortize a bond. And the straight line method, very similar to straight line depreciation, which we learned about earlier. Yeah? Similar concept. So we take the amortization schedule. So here's the example. We have the carrying value, $96,400 when the bond was issued. At the end of the bond, the carrying value is $100,000. Why is that? Because at the end of each of the interest payments, I add in the discount amount. Now, we can calculate this. I don't like to calculate it, but we can. And no, we're not going to go too deep into this because, again, these are finance concepts more than they are accounting. But here's an example using a bond premium. Now, I mentioned, just as we were talking about the bonds being a discount, we also can sell them at a premium. A bond sold at a premium is when the stated interest rate is higher than the market interest rate. Stated interest rate higher than the market interest rate, that means the bond will sell at a premium. Now let's take a look at the example. $100,000 par value, face value. The issuance price is 103.6% of the par value. What this means is instead of the company receiving the $100,000 face value, we will receive $103,600. We sold the bond at a premium. typically, and you already know this, what this means is that we're going to pay a higher interest rate. Interest dates, again, are 6/30, 12/31. It's over 2 years, so we have 4 interest payments total. The bond will mature December 31, 2019. Issued December 31, 2019. Matured on December 31, 2021. So 2 years. So here's how it works. The company received $103,600. Why? Because of the bond premium. We sold it at a premium. Remember, 12% instead of 10%. So what this means is that we received $103,600. The premium means we have a premium of $3,600. How we got that? We took the face value times 103.6%. So we debit cash, $103,600, because that's the amount of cash we received. We credit bond payable, $100,000. That's the face value of the bond, of course, because we've got to pay that at the end of the 2 years. And we also credit this account called Premium on Bonds Payable, $3,600. They call this type of account an adjunct liability account. Don't worry too much about that part. On the balance sheet, we have a bonds payable, $100,000, and we have a premium on bonds payable, $3,600, giving us a carrying value of $103,600. Now, of course, I'm going to pay interest on this $100,000 face value. Interest is stated at 12%, or I'm sorry, the premium is 12%. And I pay this semi-annual, so half of a year. 100,000 times 12% times half a year is $6,000. So I'm going to pay out $6,000. But that's not the way I record it. Pay out the $6,000, but my interest expense is only $5,100. Why is that? Because of the premium on the bonds payable. So $6,000 4 times, so $24,000 total is what I'll pay over the life of the bond. Minus the premium, $3,600, gives me a total bond interest expense of $20,400. Divide that by 4 payments. That's $5,100 of interest expense. That makes sense. Over the payments, I'm adding back in the bond payable. Yeah. So $3,600 was my discount divided by 4 periods. That's $900. I debit bond interest expense to increase the expense. I debit bond interest. I debit premium on bonds payable, $900, to reduce the bonds payable premium. And I credit cash, $6,000, because that's the amount that I pay out every 6 months. And if I look at that over time, over the 4 interest payments, I end up paying the full $100,000 back. Yeah. Plus the interest, yeah. When a bond reaches the end, the maturity, we can retire the bond. So at the end of the bond's life, we retire the bond. And the way we do that is we debit bonds payable and credit cash. Sometimes the company might decide, you know what, we're going to pay this off before the maturity date. That's cool. Yeah, there's nothing wrong with that. I prefer that because I don't like to carry debt. Carrying debt's expensive. So sometimes it's good. You might even receive a discount if you pay the debt before it's due. Yep. So sometimes we might retire the bond before its maturity date. So we have a $100,000 bond. And we're going to retire that bond on July 1. Bond has a carrying value of $104,500. The bond has a call premium of $3,000. So debit bonds payable $100,000 to retire the bond. I debit premium on the bond $4,500. That's the remaining carrying value. Yeah. And then I credit cash $103,000. I also credit this account called a gain on the bond retirement, $1,500. The gain on the bond retirement comes from the interest that I saved by paying the bond off early. Sometimes it's good to pay your debts off before they're actually due, because you end up saving money in the long term by not paying out as much in interest. That's what this tells us. Sometimes you might have an agreement with your bondholder to convert the bond from a bond to stock. Okay. Sometimes it works out better that way for both the bondholder and the company. So let's say the company agreed with the bondholder to convert a $100,000 bond par value to stock, to $100,000 worth in stock. So the company decided to, this is a great deal. So we debit bonds payable, $100,000. We credit common stock. We decided $2 per par value on common stock, 15,000 shares. That's 30,000. The rest of it was paid in capital in excess of par. With notes, they work very similar to bonds, just like we talked about. A note is typically from a bank. It's a loan. Yep. Sometimes the company might issue a loan to another company or to someone else. Yep. But sometimes the company is receiving a loan from a bank. When this happens, the company will pay the bank back face value plus interest, of course. And this occurs from the date the note was issued to the day the note matures. Sometimes that repayment could be in the form of one single payment. The company took out a loan. The loan has a face value, it has an interest amount, and it has time associated with it. At the end of the loan, the company pays back the face value plus the interest. In most cases, the company will make regular payments of the principal plus interest over time. We call these installments. Regularly scheduled payments over the life of the loan. Let's say we have a 2-year loan. Okay, the company has a 2-year loan, $100,000, 8% interest. I take the $100,000 times the 8% interest times the number of payments. It gives me my interest expense. Interest expense plus the principal, $100,000 divided by the number of payments. It's me my payment of principal plus interest every single month until it matures. It's usually the same amount. Here we have an example. Company took out a $60,000 loan to buy equipment at an 8% interest rate. Company's going to make 3 annual payments of principal plus interest. Okay, that's kind of weird, but whatever, that's the agreement. So we debit cash, $60,000. Credit notes payable, $60,000. To compute the periodic payments, We take the face amount and we take the table value of the annuity based off of its present value. This is time value of money stuff, to find the payment amount. One way of doing it. There's a couple of ways of doing it. We take the beginning balance, or we have the beginning balance. We take the interest expense at 8%, $4,800, plus the principal that we're paying back, $18,482, equals $23,282. We're going to make 3 equal payments of $23,282 to equal a total payback of $69,846 over time. So what we did here to find the amount is we took the present value factor, which we got from the table, times the dollar amount. And these show the payments that we would remake for the 3 years, yeah? Mortgages, they work the same way. The difference with a mortgage is that we make the same payment amounts every month for the 30 years or however long your mortgage is for. 30 years, 15 years, 10 years, whatever. But they're done on equal installments. It works the same way. It's the same concept. Notes payable is notes payable. Sometimes there's an annuity factor, and we use an annuity table to figure all that out. But it's easier to just have it recasted. Bonds and notes. Here's the differences. A bond or a note can either be secured or unsecured. Here's what I mean by security. A mortgage is a security. Security is the house. In other words, if you don't pay the mortgage, the bank takes the house. The house is the security. We call that collateral. Collateral. Collateral is security. You have a car loan. If you don't pay the car loan, the bank takes the car. The car is the security. Yeah. So that's what security is. It's backed by collateral. Unsecured loans are loans that are not secured by some type of collateral. Okay. An example of that would be a credit card. A credit card is a form of a short-term liability that is unsecured. If you don't pay your credit card, the bank has nothing to take. And they could take you to court and all that jazz. Destroy your credit, sure. But there's no security there. So credit cards are unsecured. It's a form of unsecured debt, unsecured liability. I'm sure there's some other examples. I think student loans are relatively unsecure, etc. So if it's secure, it's backed by collateral, like a house or a car. If it's unsecure, it's not backed by anything. A bond or a note can be convertible and callable. I can convert my bond to stock. It's convertible. Callable means the bank, the bond or the note holder have the ability to call that liability. To say, hey, pay it in full right now. That's callable. Bond can either be term or serial. Term simply means that you make one payment, the principal amount plus the interest. That's a term. Yeah. Serial means there's a serial number of payments, a series of payments. Yeah, serial. Bond or a note can be registered and bearer, meaning registered, it's registered with an exchange. And a bearer is the signer. Yeah. Couple of ratios you need to know. Debt to equity. This one's important. This one's real important. This ratio right here helps the investors to determine the risk of the investment. What you should know, personally, what you should know. This is the ratio that the banks will run on you to determine if they should give you a loan or not. Yeah. Debt to equity. Very important ratio for you personally and for business purposes. Total liabilities divided by total equity gives you the debt to equity ratio. Total liabilities divided by total equity. Debt to equity ratio. Again, very important ratio for you both personally and for your business. Bond pricing is another concept we're going to cover real fast. Bond pricing is usually based on a number of factors. One of those factors is the outflows related to the interest payments. And another is related to the par value at the end of the bond life. At year zero or month zero, when the bond is issued, is when the bond price is determined. We can also figure out the present value of a discounted amount. This is a part of time value of money. Okay. We can figure out what the issuing price is going to be based on the par value, the stated interest rate, the market rate. Those pieces of information will tell us the issuing price. We do that by taking the par value times the stated interest times time. Here's how it works. The market rate divided by 2 gives us the what we call the semi-annual rate. Market rate divided by 2 equals the semi-annual rate. Market rate divided by 2 gives us the semi-annual rate. Bond life times 2 gives us the semi-annual periods, the number of interest payments over the life of the bond. So in that, we can take the face value times the stated rate times half, half a year, gives us this interest rate to be paid out. We multiply that interest rate to be paid out by the present value factor found on the table, gives us the present value of the bond. Don't worry, I'm not going to have you compute that stuff. That's way too complex. We can also figure out the interest amortization discount by using tables. Okay. Most commonly, we look at bond interest expense by taking the interest rate, usually found from the table, times the prior interest rate. Okay. Yeah, it gets a little difficult, but one way of doing it. But I just wanted to show you that as well. An effective interest rate can also be amortized using the table method. And this is what that looks like. And I'm not going to have you run through those kind of calculations. It get very difficult. One of the last things I need to talk to you about when it comes to long-term liabilities is leases. A lease, as you know, is an agreement between the owner of the asset, known as the lessor, and the person using the asset, the leasee. If you currently rent an apartment or a house or whatever, you are the leasee. The landlord is the lessor. The lease agreement gives the leasee, the person using the asset, the right to use the asset during a period of time in exchange for cash payments, rent payments, for example. This concept of leasing can be applied to other assets like machinery. Like, for example, UDC leases the copy machines in the buildings from Xerox. Okay, the UDC makes payments to Xerox for the use of the copying machines. Companies can also do what's called finance leasing. These are long-term leases. There's a substantial benefit of the asset. What happens here is that the leasee, the person using the asset, has the ability to purchase the asset from the current owner through payments. Okay, it's kind of like rent to own. I'm sure you've probably heard that term before, rent to own. So it's the same concept applies here. You're making the monthly payments to soon own the asset. So a finance lease is a transfer of ownership of the lease from the lessor to the leasee. There's usually a purchase option involved, right? So, like, for example, at the end of the 5-year lease, the owner might come to you and say, hey, you know, do you want to buy this? And you might be like, yeah. That becomes what we call a finance lease. That's very common. Like if you lease a car, right? At the end of the 3 years or whatever, the car company will say, hey, do you want to buy this car? If you say yes, it becomes what we call a finance lease. All payments you made go toward the purchase price of the car. So that's what a finance lease is. Most companies also have what's called an operating lease. Operating lease is a short-term lease that does not meet any of the finance lease criteria. In other words, it's just very simply put, you're renting an apartment or you're renting something else. It's just a rental agreement. That's what we call an operating lease. It's a finance lease if there's a possibility of the transfer of ownership at some point in time. That's the difference between the two types of leases. And another long-term liability called a pension. Some of you might be fortunate enough to work for an employer that offers what's called a pension plan or a defined contribution plan. What this is an agreement between the employer and the employee to pay retirement benefits to you over time for the rest of your life after you've retired. Yeah. That's what a pension is. It's another form of long-term liability for the company, of course. Comments, questions, or concerns about long-term liabilities? Good. Sure. Okay. Johnny, good. All right. Okay. To recap, where we are in the classroom. Week 7. This is critical stuff, y'all. If you are late with anything, you must, and I repeat, must, get that stuff done now. Here's why. Next week is the final exam. It's the last week of the course. Okay, next week is the last week of this course. This is only an 8-week course. That's why it's so important for you to be on time with your stuff. Okay. Here's the deal. I cannot accept anything past October 16th. The last day of this course is October 16th. I cannot accept anything past October 16th. This includes the final exam. The final exam covers weeks 5 through 8. Yeah? Final exam covers weeks 5 through 8. 5, 6, 7, and 8. That's half the course. That's what the final exam is going to cover. 20 questions, true, false, multiple choice. I'm sure there's going to be a little bit of math in there. It's open and available. Everything in this course has been open and available for you to take. It's the course started. Yeah. Remember, you have 2 attempts on every homework assignment and every quiz. There's only 1 attempt on the final exam. The final exam is not timed, but it must be completed by October 16th. We'll talk more about that, of course, next Tuesday, but I just want to make sure that you're all well aware that that's happening. So please make sure that you've completed every single homework assignment, quiz, and discussion board for this course. Okay. If you got to go all the way back to week 1 and just to make sure that that's all done, make sure it's all done. Okay. The only way you can pass this course is by doing all the work. I know I've told you that more than once throughout this course. Okay. I promise you, you will not pass if you do not do the work. You should be on time with all your work, because this is an 8-week course. And for those of you who will be fortunate enough to come with me to Accounting 202 when we talk about managerial accounting, starting after the 16th, you need a C or higher in this course to move on. Okay, if you don't get that C or higher, you will not be moving on. You will fail the course and have to take it again. Okay. So, again, it is so important that you do not miss anything in this course. Make sure that you've completed all of your homework, discussion boards, quizzes, exam, homework assignments, all of that stuff must, and I repeat, must be done. And I cannot accept anything past the last day of this course, October 16th. Clear on this? I'll understand that requirement, yes?
Yes.
Thank you. Okay. As always, if you have questions, you need help with anything, you let me know, okay? You got my email address. Make sure you email me right away if you're running into trouble. You can call me, set up office hours. Whatever you need, okay? I got you. Office hours links right here in the classroom. You know how to get me. As always, stay safe, wash your hands, do the right things. I'll see you all again next Tuesday. Please make sure your work's done on time. Thank you so much for your time today. Appreciate all of you. Have a wonderful rest of your day. Bye-bye.